pricing, then I have a few other questions on free cash.
Yeah, sure. So let's address this point. In fact, I tried to address this point in the first set of questions. So basically, Aditya, in our case, when I say R, it's not UFO. It's primarily digital cinema. Cinema as an advertising medium. In our case, the content helps pushing the perspective of the advertisers, and therefore it's not necessary that if a particular movie has done phenomenally well, immediately the next day after the release, the advertisers will start lining up and changing the allocation. So here, at least a quarter is what we say, or sometimes even more, for advertisers to start re-looking at this medium. Let's look at the size of this medium. All put together, we will be less than maybe 1%. It's not 3%, right? Not as an industry. Yeah, we are now officially less than 1% of the overall ADEX. Now, if that's the case, what it means is 99% of the spends are already allocated anywhere else. So we have to really, all of us, make a lot of efforts to get the advertisers back, the advertisers' mind share back, if they have decided that, "Arey, ye nahi chal raha hai, abhi kahin aur allocation karna hai." So therefore, a 3-2 doing well will be really helpful for those who earn their profitability from sale of tickets and sale of F&B, which is your exhibition sector. But digital cinema operators like us, service providers like us, would have to wait for the past content to change the perspective of the advertiser. And therefore, we are really hopeful, and things are also looking positive for this Q3, where the content is really having some good names in next 3 months. So that's the reason, basically, a good 3-2 necessarily need not help us to immediately push my volume.
Okay, because I thought your business is directly correlated to success of Bollywood, right? Like, because when you have footfalls increase in Bollywood, it should show up on your.
But it is with a lag. Aditya, what we're trying to say is it comes with a lag. It is directly and indirectly linked with the success of the way the content behaves in a way that it is able to get the footfalls in theaters, because ultimately what advertisers are looking for is footfalls. So this lag is always there, though it is directly related.
Okay. And so how should one think about your business? Like, basically, like, you had hits in this quarter, but it doesn't show up. Next quarter, there may not be any hits. So then again, nothing will happen. So, like, you need like a sustained period of hits for advertisers to come back to this medium, or what is the turning point?
No, it's not really like that. Currently, it is looking like that because, as I said, that for 1%, which we all are, we have to really make a lot of efforts to get advertisers to start looking at us again. But right now, it looks like it's a game of content. अब ये quarter में है तो advertisers next quarter आएंगे, next quarter नहीं है तो उसके अगले quarter क्या? But if you actually go back in pre-COVID period, this always was a situation. There will be a good content, there will be a bad content, but nobody used to really discuss so much about it, and people used to go and start watching the films. What has now happened is, for some period of time, people were choosing which content to see, and therefore the average consumption that which we always keep referring at 5 to 7 movies a year is the average consumption of a typical cinegoer. That also was reduced. Now, honestly, it's a change in habit, and we were waiting and seeing whether it's a sort of a permanent in nature, which would have been disastrous. And I will just give you one data point which will not make me speak more about it. But in last 3 months, you would have seen so many re-releases, and re-releases doing good. In fact, Gen Z also is going and watching a movie of 1990, and that what it is telling us is people really want to go out in the theater and have some good time there. Okay, not necessarily they have to chase the content and go there. So hopefully this consumption pattern goes back, and where I'm seeing 5-7 movies a year, people keep watching. and there's not much of discussion continuing on social media about ye acha hua, movie kharab hai, all that. If that happens, we go back to a normalized consumption scenario. A normalized consumption scenario will help us to go back to the advertisers and get a higher allocation. That's it.
Okay, great. No, thank you so much. That is very helpful context on consumer behavior. Just maybe two questions, I'll lump them together. One is, can you just help understand, like, however you define it, but like free cash flow, how much does this network throw off in terms of cash? If you look at, let's say you've normalized your acquisitions and so on, and what is the free cash flow generation of this business pre-COVID and now what is it? And you can define that as cash flow operations minus your, I don't know, 10 crores capex or something like that. But just give a sense of that first question. And two, just on the percentage sharing number, that's still quite high. But and so then again, you're almost like working for the exhibitor rather than your network. But when does that normalize and how does that happen and what kind of timeline should we expect that to come to 45, 50?
So let me take second question first. We tried to actually address this, Aditya, at length, that how from 85% we have come down to 69 and why the sharing itself is at so high level, because we are trying to improve the quality of network and we were successful. We have over 2100 multiplexes on our network today, and that's the reason why the commitments were higher. And as the revenue goes up, the percentage sharing would keep dropping down. That's an elaborate discussion. I would request my IR team to connect with you and share those details with you, what we discussed, so that there is no repetition for the rest of the investors on the call. The first question that you have said, I would like to slightly tweak. Instead of just telling you what my cash generation was, what it is today, let me try to put it slightly differently, and if that helps, good. Otherwise, I'll go back and get you the actual data. Of course, that's there in public domain. The way to look at our business is, today what you are seeing is we are making some amount of profitability, well, at EBITDA level, at PAT level, we are almost there. But from here on, the trigger for pushing the revenue and profitability up is only and only the volume and the pricing of the advertisement minutes. So from my current 2.7 minutes per show, if I double, theoretically, if I double it, the volume and double my pricing, then I'm looking at 4 times the same sales. Whatever sales I have done, 4 times of that will be my new sales. And against that, you don't have equal proportion of expenses such as sharing. So that is what almost 50 to 60%, 55 to 60% of my incremental revenue would directly go in PBT. And against that, there is no compulsory capex that we have to do. We are basically milking my network. So you can consider whatever my numbers are showing you on 6 monthly basis as a minimum base, and then you can have your own estimates about where the volume and pricing can go of ad sales, and around 55-60% is going to get into your PBT, and that is nothing but your free cash after the taxes are taken out.
Okay. Yeah. Any specific ballparks in terms of past and future? Assume just assume normalized pricing, because you don't know what the market clearing price is for your network right now. But if you assume maybe 10-20% higher pricing, 30% higher volume, like what does your cash flow come to, something like that?
So first, if I have to actually do that, I have to give an guesstimate about where I'm seeing
just guesstimate
pricing grow and when, and that's the reason why we generally, or rather we have never given that indication. But if you do this math, which is simple Excel, you take current base and incremental revenue, 55% of that goes in bottom line. Revenue to be determined by minutes and the spot rate.
I've done the math. It's just that those numbers have not turned up yet. So.
Actually, we have come a long way from where we were in the middle of the pandemic. And I think I keep saying that we have a slow path of recovery for all of us, and we are also one of the the industry players. Now on, I think we should start seeing a major push.
Yeah. No, good luck. I think it's still undervalued, but it will hopefully come through. Thank you so much.
Thank you. Thank you, Ravi.
Thank you. Next question comes from Ashish Goyal from Max Rock Investments Private Limited. Please go ahead.
Hi, good afternoon, and my festive greetings to the management. I have a couple of questions. Am I audible?
Yeah.
My first question was on the sale of equipment business. So this piece has been doing good for us since the COVID period. And what would be the primary reason for it, and is it sustainable in the long run?
Yeah. So the sale of equipment business is done in two regions. One is in our Middle East operations and also in India. Largely the business is in the Middle East for the sale of equipment. And this has been pretty much a steady state business for us. And in India also, as the aspirations of the cinemas are increasing and more people are entering into this business, they are also looking at buying of the equipments. But when they buy the equipments, they need an integrator to one, sell them the equipments, maintain them, and also provide them business support services like providing content and advertising sales. So this is also something which we encourage because this allows us to participate in the business without investment from our side, but still gives us value on the sale of equipments over here. So this is something that we would look at pushing in the future also. And as far as the Middle East is concerned, I think Saudi Arabia, when it opened up last year, it had a very decent uptick over there. And we expect to see good volumes in that region from that perspective also. So increase in the sale of product is a good indicator and something that we look forward to.
Just on number fronts, in this quarter, you see 22.5 crore of sale of product revenue, and almost margin on that is 5.7 crore. Of that, out of 22.5 crore, almost 17 crores is in Middle East operations. And out of 5.7 crores, 4.7 crores is in Middle East operations profit. Margin, I mean, not the profit, the direct margin. So in this quarter, the Middle East has contributed significantly higher.
All right. Thank you. That was helpful. Second question would be on the screen addition front. So just trying to understand that we have added few screens and more of our now screen counts are like the multiplexes, which we call the prime screens. So just wanted to understand how is this increase helping us in the overall business, as on the the face of the revenue, we don't see much of a movement on that. So if you could just help us understand to put the numbers together.
So, sorry, you mentioned that there is an increase in screens?
No, I'm saying in addition of new prime screens, the multiplexes,
Yeah.
And maybe some movement in the new screen count. How are they going to help us in our core business?
Okay. So firstly, your observation was the new screens adding is not adding to revenue. So on face of it, the revenues have not moved, but at the same time, the unfortunate fact of the industry was in this period, not many screens also closed down. So in one of the questions I had given data point where I said that in Q4 FY20, my screen count was 3792 ad screen count. Today it is 3735, so almost 60 screens down. This is in spite of adding lot many new screens. And why I'm saying so? While the screen count is almost there, my multiplex screen count has moved from 1565 to 2122. So almost 600 screens I've added in my network, which are multiplex category. When I say those got added, but my number of screens overall remained the same, which means other category screens closed down. So what happens is when some of our revenue streams such as rental and CDC is directly linked with the number of screens because we don't have a differentiated rate there, which is directly linked with the quality of screens as such. Some correlation is there, but not a very direct link. So therefore, overall my number of screens have remained where they were, and therefore these two revenue streams would also remain where they are. But a better quality network helps us to position ourselves better, as I said in the previous question, before the advertisers, and that is what should start happening from now on.
Okay. Thank you. And that is from my side.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. We have a follow-up question from Ankit Kanodia from Smart Sync Services. Please go ahead.
Thank you for allowing me a follow-up. So I just need to ask one more question. Since our share price has come down sharply in the recent months, and we have a good enough liquidity, are we having any plans of maybe announcing a buyback at this price, at this valuation? Given that we believe that the medium-term and long-term outlook are in favor of us. So are we discussing on those lines?
So answer to that is no. The liquidity that you see is basically what we have managed to get through. We've managed to get fresh infusion into company during COVID, towards the end of COVID period. And actually that has helped us to have a very decent cash position. So today we are still very positively on a net cash positive level. So there is no discussion around buyback. Even technically, there is no possibility of buyback because I am sitting on huge accumulated losses. So that is also a challenge. Anyway, keeping that aside, there is no discussion around buyback. We are more focused on currently getting the business back on track, both on screen addition front and more importantly on the advertisement revenue growth front.
Sir, I didn't understand the accumulated losses part because I see the reserves are positive. How can accumulated losses you're talking about?
So the reserves that you see would be on account of share premium.
Okay, got it. Yeah.
Yeah. Business losses which were in first 2 years of COVID.
Got it. Okay, sir. Thank you so much. And all the best.
Thank you.
Thank you. Ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. Ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. There are no further questions. Now I hand over the floor to Mr. Tushar for closing comments.
Thank you. On behalf of Ventura Securities Limited, we would like to thank the management of UFO Moviez and the participants. Good day.
Ladies and gentlemen,
Thank you, everyone.
Thank you, sir. Ladies and gentlemen, this concludes the conference call for today. Thank you for your participation. You may now disconnect your lines. Thank you and have a good day.